Good afternoon, everyone. Thank you so much for joining us today for our HealthLinks webinar. My name is Michelle Hahn, and I am the Community Programs and Events Manager for HealthLinks. And one of my favorite parts of the job is coming together and working with our partners to create presentations and webinars like the one we have today. So I appreciate you all taking the time out of your busy schedules to join us. I think we're going to have a great presentation from our partners at Wealth by Design and celebrate our Financial Health Literacy Month, which is the month of April. So before I hand it over and do a quick introduction for our speaker, I'd like to go over a few housekeeping items for you all. So first, we're going to keep you all on mute today. If you have questions that you would like to ask, please feel free to use the chat box on the right-hand side of your control panel. There's also a question and answer box that probably popped up for you as well. If you type in a question into either of those areas, we'd be happy to answer them, and we'll make sure that we have time at the end of the presentation to respond to those. We are going to be recording the webinar today, so if you find the information super valuable and know of people that were not able to join us today, we'll be sending it out in a follow-up email. Feel free to forward it and pass it along to your colleagues, friends, anybody you think might find the information useful. I will also be including the contact information for our presenter today if you have other specific questions or want to connect with her after the presentation. And there will also be a quick survey. We love getting your feedback and wanting to find out how you enjoyed this presentation and then what other presentations we can do in the future. We host about 2 webinars per month, and we're always trying to find exciting topics that are helpful for you all. So please give us some feedback and take just a couple of minutes to go through those questions. With that, let me introduce our speaker for today. So Danielle Howard is a certified financial planner. She's an author, speaker, and a personal finance thought leader. Her 24 years of client engagement and financial world experience has led her to become a catalyst for change around the financial tools, techniques, and temperaments that construct a person's financial life. Understanding the integrations and implications of a whole life perspective on money mindsets and financial decisions, she really guides people on the progressive journey of financial wellness. She helps bridge the gap between Wall Street and Main Street, talks about complex financial topics and concepts and brings them down to earth. And she opens the door to new conversations around money by really breaking it down. I know we've worked with Danielle quite a bit through HealthLinks. They are also a recognized healthy business, and they do great work within their community up in the Basalt area. And we're very excited to have her here today. So I don't want to take any more of her time. So with that, Danielle, I'll hand it over to you.
Thank you, Michelle. Thank you, HealthLinks Colorado. Not only is April Financial Literacy Month, but it is National Social Security Awareness Month. And this week, timely that we decided to do it this week, just finding out that April 9th through the 13th is National Retirement Awareness Week. So we got lots of stuff going on and lots of reasons to hone in on our financial lives and do some thinking about it. So let's dive into it today. Thank you so much for having me. We are going to look at navigating your vibrant and viable financial adventure. My journey in the financial world has been epic over the past 24 years. And there's a growing number of us that are what we look at as life financial planners. And we contend that the financial services world has it wrong, that it's not about getting to a designated age with that number in the bucket or under your arm as you see some of the advertisements carrying around. It is no longer retiring from something, but rewiring for something. As a certified financial planner, the majority of my clients are pre-retirees and retirees, and I have the privilege and honor of helping them navigate this new season of life. Today, we're going to delve into this metamorphosis, this change that is going on, that is markedly different in character and appearance than what we previously thought. This is a picture of the Hokulea. My daughter got married. She lives over in Hawaii. Yeah, bummer, I know. And this is a Polynesian sailing vessel that navigates using the stars, the sun, ocean swells, and other signs of nature to get from location to location. And they recreated this, and they sail around the world, and there's this whole society, and it's really, really cool. And we were there when it pulled in to Kauai. However, we don't want to navigate by the stars with our financial future, and knowing that just a 1% change can completely shift the trajectory of where we're headed. And so we're very fortunate that we have a plethora of tools and techniques to keep us on track. You know, if you're 5 years within transitioning towards your full season of your physical life, there are course corrections that we want to make and that we can keep in mind as we move forward. So as you look at what retirement used to look like and what it is looking like now, what do you want it to look like for yourself? What did it look like for your parents or grandparents? And how do you envision it? You get to define how it's going to look to you. You get to be a victor and not a victim of your financial life. I contend that, you know, if you spend a little time focusing on this stuff, work with trusted professionals, have conversations, change the conversations around money, that we get the opportunity to totally recreate what is going to take place. And as we know that as the butterfly breaks out of its shell, out of its that little husk there, that it needs to, it might be a little painful, it might take a little time, a little intention. Nothing is ever easy. So you definitely want to know that it's some work, but it's all worth it. How do you want to redefine it? We're calling it rewirement, refirement. The owls were a little older, we're working less, but still earning. The encore years, the sagers, the vesper years, we get to redefine it. It's a combination of the emotional why and the tangible what. How will you feel when you get your financial life in order to the best of your ability as you move towards this season? What does it look like to have a healthy, vibrant financial life? I contend that it includes bringing money into your life with integrity, dignity, competency, joy. These are the emotions that surround it. You want to be able to give of your financial resources with moxie and momentum, to nurture and grow your resources with diligence, wisdom, and care so you know that you have sustaining power. And then you want to look at spending within safe boundaries and joyful intention. What will be the impact if we address all of these components? We're going to get fireworks. With your unique version of prosperity, we're going to look at lifestyle, longevity, and legacy. And that we will have deeper relationships, more fulfilling lives, minimal regrets, and sustainable cash flows as we move through this continuum. What does your adventure look like? Let's break it out a little bit. With this lifestyle piece, what does your lifestyle look like? How do you balance that vacation and vocation? Again, let's not retire. Let's look at what it's going to look like to rewire or refire. How are you going to stay engaged, continuing to get educated, enticed, excited about this new season of life? And there's a lot of research out there that is looking at, you know, that not only the emotional changes that go along with the financial changes in retirement. And so much of the financial services industry has been just solely focused on the financial piece. Again, build up your big buckets. And they're starting to do more research on the emotional changes and understanding that if you don't re-identify, because so much of our identity can be wrapped up in what we have done to earn a living for a long, long time. And we want to look at, how is that going to change? How do relationships change? You hear over and over again, what happens when the primary breadwinner is now at home a lot more, and that can cause a little bit of upheaval in the household. So, taking a look at what your lifestyle looks like in this time frame. You were all sent, if you joined and signed up for this event a little bit ahead of time, Michelle sent out this Wheel of Life. And this is a tool that I use that is really very powerful as you look at life balance, as you look at areas of your life that exist right now and how those will be changing as you move into this fall season. What you want to look at is where you're at now, and you might want to print out 2 of these, and you can look at where you are now and what may change as you look at what retirement and your version of this season of life, what it looks like. And what do you want to balance out? There might be things that right now, in your current life, if you're working a lot and you're not too sure about where you're at financially as you head to this fall season, that you want to address. So as you do this exercise, the main thing, the way you want to do it is to put a little button on each spoke of the wheel. Towards the inside of the spoke means you're less satisfied, and out towards the 10, you're more satisfied. And it's your definition on what you call family, what you call learning, what you call home. It's not my definition. But then what you want to consider is the implications, the financial implications of what it might look like to inflate, a part of a wheel. So let me give you an example as we look at, lifestyle piece of this. Many people will, look at the fall season of their life as an opportunity to travel, have more leisure time. How do you do that within the parameters of a safe spending plan? So in order to inflate that side and to become more satisfied that you are going to be able to do that traveling, you may need to know where that money is going to come from, for how long, how do you take distributions off of different assets, or how do you tap into different pieces. It may be that you're looking at rewiring and going back to school. You may want to go back and get some additional education around something you've always wanted to learn about. Well, that may cost some money. So how do you want to look at your financial resources to discern where is that financial support for that learning component of your retirement phase going to come from? What is the most tax efficient way to take it? Use this as a tool to just start having some conversations around this area in your life that you are moving towards. If you're, again, maybe you still have many years till you're thinking about retirement. Use it as a conversation tool right now as to how you want to look at inflating areas of your life that you need to spend some time focusing on. So feel free to use this as a tool for family conversations, for personal introspection, and then you definitely want to say, what would it look like for me to take a 1% shift? What would it look like for me to improve this area of my life just 1%. Again, in the long-term trajectory, that makes a huge difference. And sometimes when we look at changes, we go, oh, I have to make 180 degrees. And then we self-destruct because it's, those types of changes and new habits can be, intentional. Similar to what HealthLinks does is a lot of work around our physical lives. And we know that sometimes doing physical changes, if, I have these major goals out there that I can get frustrated if they're not SMART goals, measurable, attainable, timely, all that. But if we start off with little bites and then we start working on building on our wins, we can make a huge difference. So as we look at longevity as the next component of our financial transition and this adventure of navigating this financial adventure, this is always a challenge. How long are we going to live? I don't know. We know that we live in Colorado, and we know that Colorado is one of the healthiest states in our union. We know that we have people like HealthLinks that are trying to incorporate healthy environments within the workplace that are going to have us living longer. There are all sorts of books and research and new food choices that are out there that are giving us all sorts of opportunities to make healthier choices, which means we're probably going to live longer. We can look at Social Security reporting and show what an average longevity based on actuarial numbers are. But personally, I think people in Colorado are above average. So I think that we're probably all going to have a little bit more longevity. You may look at your family genetic history. You may want to take a look at how are you going to want to sustain that longevity. There's different types of financial tools that are going to address the longevity arena and that you may want to dig into. As you look at longevity, we have three components of it. The go-go years, the slow-go years, and the no-go years. Now it matters how you take distributions from various financial assets and from where in order to maximize the sustaining power of those resources. Do you want to slide into the grave, writing your last check and then have it bounce? Or do you want to live in a way that you have margin in your finances and can hedge that longevity in order to minimize those potential implications on your family? Downside is if you don't manage those, you are the beneficiary of the Medicaid program and you have a lot fewer choices. You definitely want to take a look at how to manage your financial resources in longevity. And then finally, the legacy piece. When we look at having a vibrant adventure through the fall season of life, something else that's really important to look at is our legacy. What do you want to be remembered for? Creating that legacy is much more than passing on the financial assets. And for many people, I think it's the more important part of it. So there's a huge difference between, wealth transfer and estate planning. When we look at, transferring financial wealth, you want to look at passing on insight and sound judgment. Wealth very rarely creates wisdom. So how are you preparing your heirs? You wouldn't let somebody fly a plane or drive a fancy car, as cars are getting fancier by the moment. That isn't competent at the control. Money is a complex tool. And as your life gets more complicated, you need to look at the different moving parts and make sure they're passed on prudently and proficiently. Right now, current estate laws allow you to gift up to $15,000 to anyone and everyone you want without having to file a gift tax return. So this is a way to pass money on while you're living. There's a current lifetime exemption of $11,200,000. Most of us don't have to worry about that, but you don't need to die to pass a financial legacy on. But you want to look at the timing component of wealth transfer. So as you look at what your financial finish lines are, and answer very important questions, not only for the legacy, but for your lifestyle. How much is enough? Then you can free yourself up, without, fear of missing out on something that's important to you or lacking in your own personal provision. You can give while you're living. And if you want to do that, you want to make sure there's no strings attached and that you're giving in ways that are truly helpful and won't hinder people from their potential. There's a lot of moving parts in this legacy piece. And, I just encourage people to look at being more mindful about all their financial decisions, because each financial decision you make does have an impact. It has an impact on your own personal life. It has an impact on those who are impacted by your personal financial decisions. It might be a child, a spouse, a parent, and it has ripple effects throughout our economy, throughout our world. And the more we can start getting in touch with our personal financial decisions, whether it's pre-retirement or during retirement, you are going to feel a lot better about the impact that you're making. So as we look at, a lot of things that are changing, there's things that we know are always going to change, and tax reform just, in 2018, we got some new tax reform laws, and we know that will change down the road, but we need to constantly keep up with what's going on with things. We've got new tax brackets that we're dealing with. They've changed quite a bit from not a whole lot. We actually have one more tax bracket than we used to, and now they've gone up, 10%, 12, 22, 25, 32, 35, and 37. How that will impact you, everybody's in the process of doing their taxes right now, and I work with a lot of accountants who are trying to continue educating their clientele on how this is going to impact you. How will, moving forward, whether you are still working or how, you may be bringing money in from different areas, you just want to understand how these tax brackets are going to impact you and be as proactive as possible to keep more in your pocket. With more moving parts to it, you want to keep your modified adjusted income down, because you want to look at how to optimize that financial flow as you navigate through that lifestyle, longevity, and legacy. With Medicare, once you hit the potential to take Medicare, it looks back 2 years, and your modified adjusted gross income determines how much you are going to pay for your Medicare Part B. So if you can keep your modified adjusted income as low as possible as you head towards retirement, it will affect, how you get taxed on Social Security benefits and what you're going to be paying for these Medicare premiums. Again, if you're, you need to keep an eye on this. They have now doubled the standard deduction and eliminated personal exemptions. You will need to look. You have been in the place of doing an itemized return. Many of these itemized deductions have been eliminated. estimated, and significant changes have been made. So discuss your situation with your tax professional to determine, should you still itemize or take this new standard deduction because it's now doubled from where it was. And if you're over the age of 65, you can increase that standard deduction by $1,550 if you're single or head of household. And if you are married filing jointly, whoever's over 65 can add an additional $1,250 on to that standard deduction. So it makes the standard deduction pretty nice, but you still want to look at, what other itemized pieces can you take advantage of to determine what is best. Many people, as they move towards their rewirement years, take a look at, how do I use the equity in my home? And if you want to sell your home, there's all sorts of different ways you can use your home. And you want to explore what is going to be the best way. But again, looking at just what happened with tax reform, you can still exclude the gains of up to $250,000 if you're single, or $500,000 if you're married filing jointly when you sell your primary residence. You have to live there a little bit longer. So if you sell your home after December 31st of 2017, you will have to have used that home as a primary residence for 5 out of the last 8 years if you want to claim this exclusion. So it can only be claimed once in every 5-year period. So, a lot of people lived in their homes for quite some time, and you decide you want to move to a warmer locale or downsize, and use that tax efficient gain on your home to maybe provide you with some liquidity. With tax reform 2018, there were also some changes in the 529 savings plan. This I talk about just from the standpoint of many grandparents are funding, grandchildren's college education, and this is just a way that, again, you can give while you're living in a way that is going to invest in the human capital of your grandchildren. So the tax benefits are now extended to eligible education expenses for elementary and secondary public or private or religious schools. So this is different. 529 plans used to only be able to be used for secondary education going to college at accredited universities, and there are accredited golf schools, there are accredited cooking schools, technical schools. But now it has changed that you can use it for primary education, and it allows you to withdraw up to $10,000 a year from the 529 plan per student for educational costs. You want to be careful with this. Many times I just caution people, you don't want to pay for private primary school and not have anything left for secondary education. So you want to make sure you plan that all out. Another piece with tax reform, if you are a small business owner, and again, please, talk through all of these pieces with your accountants. But as we look at, the Health Links crowd is a big group of small businesses that right now the income just passes through. So, an S corp, small LLCs, they don't pay corporate income tax. Instead, the owners report that corporate profit, as their own income. They pay taxes based on your individual income rates as personal income. So the limited liability companies, S corps, and sole proprietorships are now have the opportunity to look at deducting up to 20% of their qualified business income from their businesses. individuals earning $157,000 or married couples earning $315,000 are eligible for the biggest deduction. Again, there's a lot of nuances with this, the type of businesses you are, so please dig into this with your accountants and tax professionals. Social Security. This is a big one. There are over 500 different ways to take Social Security, and you really want to take a look at, if you're contributing now, and how to maximize what is going to be available to you. Again, with small businesses, I have seen where the accountant will minimize the amount of W-2 income and then just pull off draws. The challenge with that is you aren't putting very much into Social Security, so you better be putting some aside into a employer-sponsored plan of some sort, a step, simple, 401k, and make sure that you are being intentional about how it'll play a part in your future income stream. Make sure that you're checking your Social Security report. You want to know how much is available to you now based on your current earnings potential, what it would look like at full retirement age, what it might look like if you take it early or delay it. And what we have found out that calling Social Security, they will implement whatever option, excuse me, that you tell them. If you say, I just want to pull it out early, they give absolutely no advice, and they don't share what your options are. So you want to really make sure that you are intentional about what you're doing with the Social Security component of your future financial life. If depending on your current or previous marital status, if you've been widowed, there are all sorts of different options that you need to take a look at. If you have investments and other assets that you can tap into prior to Social Security, that may be warranted in pushing Social Security off down the road. Social Security, pensions in Colorado, para, those are income streams that for longevity, you can't outlive. Those will pay you until you write your last check going into the grave. And that can provide you some peace of mind with longevity. However, you want to make sure that you're maximizing what you can get out of it. With current or previous marital status, if you were married for at least 10 years and divorced and have not remarried up to certain ages, you can collect benefits off of your ex-spouse. You want to weigh what would pay you more, your own personal benefits or your ex-spouse's. There might be a reason you would want to take a spousal benefit for a period of time and push your own Social Security benefits off to a later age, around 70. If you have been widowed and you were married for at least 9 months, you qualify for benefits. These are important things for people to dig into, for them to know, for them to research what their options are and how their options with Social Security fit into the other moving parts of their retirement portfolios. Something else that's really important, if you're requesting a report from Social Security, notice the wording on the top of it that says, you have earned enough credits to qualify for benefits. At your current savings rate, if you continue to work until, And many people don't read that full, little small print, and they just look and say, okay, well, if I stop working right now and start collecting, let's take an example. You're 58 and you want to stop working, and you look at your Social Security report and you see, oh, if I retire at early retirement at 62, I would get this. Or at full retirement, whatever that means for you, around age 66, or at 70. But the caveat there is you probably end up with less if you completely stopped working at 58 or 59, because you're no longer contributing into the Social Security program. So that can be a little bit of a misnomer if you just look at the Social Security report, decide that you're ready to be done with things, you're going to live off of other assets until you're 62, and then start collecting. You want to really make sure what your options are. When should you take it? Always the question. Are there other work-related income streams that you're looking at having? We see a lot of people moving towards, looking at the gig economy to bring in some extra money. How would that impact your Social Security? So if you decide to drive for Uber, or if you were going to use bring money in by hosting people with Airbnb, or you're going to consult out and do some work with TaskRabbit, how would that work affect your Social Security in a variety of ways? Bottom line, what kind of cash flow is needed, and how long do you think you're going to live? There are break-even points that there is software out there that we use in combining other financial assets and kind of looking at longevity. If you were to start taking it early versus pushing it down the road, combining other resources that you have, that there may be some break-even places with Social Security that would be important for you to address. Another thing that I just encourage people to do is that at your full retirement, which is again based on your age, somewhere around age 66, is to just, even if you have decided not to take Social Security, but to push it off till 70, go ahead and do what they call file and suspend. So you're filing for Social Security, but you're telling them you don't want to start taking it. What this does is it gives you a window. It gives you a little bit of margin to change your mind. So for example, you file and suspend at age 60 at full retirement. And in 2 years, you had every intention of pushing that Social Security distribution out until age 70. However, at age 68 and a half, you've been diagnosed with a disease that they're saying you're not going to live very long. You could actually go back to Social Security and get all the money that you could have received from your full retirement age. If you do not file and suspend, then you can only go back and get a year's worth. So, it doesn't hurt to file and suspend. The upside is great, push it off until age 70. But if you were to need to start taking it earlier, you would have that option to change your mind if you capture that past payment that you had decided not to take. Let's talk just for a moment about some of the health savings accounts. For many of you who are working at companies where you have a high deductible health plan, you must be participating in a high deductible health plan. This is a tool that gets tax favored in 3 different ways. And it can get set up to pay for medical expenses of the owner, spouse, or if there are any dependents. The contributions to an HSA are deductible from your gross income, and growth inside that account is not taxed. So there's one tax benefit, it's deductible from your gross income. Then another tax benefit is it grows inside the account, tax deferred. And then when the distributions are made to pay for qualified medical expenses, you get those income tax free. So the funds can be held year after year for future growth. It's not one of those use it or lose it like a flexible flex savings plan. You can't be enrolled in Medicare. Once you enroll in Medicare, you can't participate in the contributions. You can use it for distributions, but you can't put any more money into it. The tax deductions right now in 2018 for a single person, $34.50, and married filing jointly, $68.50, and there's $1,000 catch-ups if you're age 55 and older. The younger you are, if you can participate in these, these are awesome ways to get some tax deductions on your current return. The first page here is to lower that adjusted gross income, and to build a huge, big resource down the road during retirement. As that, you can pull money out of it. It isn't reflected on your tax return. It keeps your adjusted gross income down, and it has some pretty sweet benefits to it. So if your employer offers an option for an HSA, check that out and dive into it. With your retirement accounts, we are covering a lot of ground here. You guys are great. So with your retirement accounts, you're going to have a lot of options. And if your employer offers you a current plan, take advantage of it while you can. There's all sorts of catch-up contribution based on the type of plan you have. And usually after you hit 50, you can stuff more away. So please check with your plan administrators to determine how much you can get in there. You can get more into your personal retirement accounts, depending on whether you're contributing to an employer-sponsored plans. There's going to be some limitations and phase-outs, so do your homework. So look at what your options for distribution, transfer, rollover, based on what your needs are for lifestyle, longevity, and legacy. There are different types of retirement accounts that have benefits in each one of these areas. Make sure that you're reviewing your beneficiary designations every once in a while, or as your personal life changes. I've seen retirement accounts that have spouses that have passed away on them, or ex-spouses. So you want to make sure that you review your beneficiary designations. We're seeing a lot of transfer and of wealth, and especially as people enter this fall season of life, many people are inheriting IRAs and plans. You want to really make sure that before you make any decisions on those, you use a lot of discretion and discernment. You can make some mistakes in there that you can't undo a lot of them. You want to make sure that if you are a spouse, especially, and inherit, such as, here's an example, you have your spouse has a 401k, and you are not 59 and a half years old, and your spouse passes away. If they have money in a 401k, you could tap into that 401k without getting hit with the same kind of tax. If it's a beneficiary 401k, you would not get hit with the same kind of penalties that you would if you rolled that over into your own IRA. So if you need cash, be careful, because if you're needing that cash, you don't want to move that 401k into a personal IRA as a spouse, because you wouldn't be able to get it out tax-free. As you shift between that accumulation phase and the distribution phase, there's a lot of things that change. And you want to make sure that you're using each of these tools wisely. If you're charitably inclined, you know, this is mostly for people who, it's entirely for people who've reached the age 70 and a half and have to use that required, tap into that required minimum distribution. This is another way to minimize what comes onto the front page of your tax return. If you are 70 and a half and need to start taking your required minimum distributions, you could give it directly to a charitable organization instead of taking it as income and then writing a check to the charity. It's a very creative tool, again, to minimize what you're going to be paying in taxes, and again, how that would affect your Medicare Part B and what kind of taxes you end up paying. When you are looking at whether they're in taxable accounts, brokerage accounts, or inside of your just brokerage accounts, you need to look at what is changing between your in your asset allocation model. How are you diversified? Many people will tend to just set an investment strategy and forget it. Now, a lot of our investment companies now have target date portfolios or retirement series, and they adjust and they rebalance for you. So if you're making your own investment choices, you definitely want to make sure you're addressing your asset allocation, rebalancing, and diversification. You want to also look, many times people will just look at one account and look at the asset allocation and how it's diversified. You want to look at your portfolio as a whole, the whole big enchilada. There may be reasons why you want a Roth IRA to be asset allocated and diversified differently, because maybe you don't need to tap into that one in the next 5 or 10 years. Maybe you're setting that one up more for legacy, because it passes on to your heirs income tax free, and they take distributions off of it, you know, income tax free. You know, so you may want to have different strategies within each of your portfolio, but you want to look at it as a whole. And you want to look at the tax efficiencies within all of them. So to say, how are your, you know, what asset buckets do you have? You know, to reconnect, do you have non-qualified accounts, brokerage accounts? Do you have life insurance, cash value? Do you have annuities? Do you have home equity? Where does everything reside? Reconnect with what you have and where it is all at. Too many people just hit, you know, 5 years before retirement, and you know, and then they think, oh, I can just go with the 4% distribution rule and take an equal amount out of my accounts. You want to be a lot more strategic, because again, we're dealing with longevity here. Tax loss and gain harvesting is huge, especially outside of your tax portfolios, because you are experiencing, you buy and sell something, you're experiencing a taxable event. These taxable events can help you, or they can have less money in your pocket for the long term. So when you can, and we've experienced this year, a lot of volatility in the market, that can pose opportunities for you to do some loss gain harvesting and really maximize the strategy within your portfolio. Another idea is, as you're looking at your portfolios, is to look at if you've got, you want, let's take, for example, you may want a balanced portfolio. Balance will just say 50% income focused and 50% equity growth focused. So with your income, your bonds, those are generating income. And if they're outside a tax sheltered tool, they're in just a brokerage account, every year you are experiencing a taxable event. So if you can keep your equity, your income-based investments in a tax sheltered vehicle, such as an IRA, an annuity, Roth, and you're not getting hit on taxes. And then in your non-qualified account, your brokerage accounts, those can be invested more for equities, the growth opportunities. Those are, you're going to have less taxable events until you actually experience a sell. This is a way, again, your overall portfolio will be balanced, but you can be more tax efficient and have a little more tax efficient strategy with your overall portfolio by positioning different assets in different tools. I encourage people to do what's called an investment policy statement. So this is something that you want to, it guides you, and you consider, why do you want to have these types of investments in this particular investment vehicle? It gives you some emotional parameters, some guidance as far as when would I rebalance, what kind of investments do I want to stay away from, what kind of investments do I want to be a part of, and to make sure that you are rebalancing as appropriate. And it helps to guide you. It keeps you from getting emotionally, when you see market corrections and different market seasons out there, that it keeps you from making mistakes and actually hurting yourself. It's a good tool to use and then revisit and make changes in if necessary. As we start winding this down, and you guys have had an earful today, this is so much information. Thank you for hanging in there. Think about your last vacation. What went into planning it? What went into the execution of making that, amazing and memorable experience that you dreamed of? You probably had a lot of people involved. There was a pilot on that plane. There was a chef that cooked the meals, or the hotel concierge that assisted with the experiences you wanted to take in. You probably started with a twinkle in your eye and go, where do we want to go? Why? What do we want to accomplish on this trip? And you looked at the why before putting all the moving parts into place. Your next vacation may be 6 months out or a year down the road, but time flies. Same thing with looking at our fall season of life. We want to look at starting to plan now to make the most out of this adventure in aging, and to really look at those different components of lifestyle, longevity, legacy. Don't just let it happen. Engage the people that will help you make it an exceptional experience. We've got a couple different things going on here at our office. This is my little moment to make a plug. This is a interactive workshop that we are doing with businesses. It can be done just focusing on the retirement in your business, or it can be used as a way to really help people understand behaviors, mindsets, and tools and techniques of doing their money differently. If that's something interest of you, we can give Molly a call at our office and we can explain it a little bit further. My book is available on Amazon and at Barnes & Noble. 100% of the proceeds benefit financial literacy programs with our youth. And if you would like to download my monetary manifesto, you can go to DanielleHowardForYou.com, and that will give you a great pinpointed outline on how to do your money differently. I'd like to thank HealthLinks Colorado for this opportunity to present today, and encourage all of you to look at what it's going to take to do your money differently, whether you are headed towards retirement or that just seems like such a long ways away.
Thank you, Danielle, so much. That was a lot of information. I know. Thank you all for being on the phone. Really great and helpful information for us to take a look at our finances. And as I mentioned before, if you would like to take a deeper dive or more one-on-one support with Danielle, I'll send out her contact information in the follow-up email, along with a link to these resources that she mentioned today. But we have just a couple of minutes. If anybody has some questions for us, you can type them up in the chat box if you'd like. And yes, Danielle, thank you again for taking your time to put this together. You know, there's a lot of information to share with us, and always helpful to have you break it down for us into a manageable way.
there is a lot here, so you guys are very brave.
Great.
And I just want to encourage people in the workplace to take a look at, you know, as an employer, as a benefit, you know, what are the employer benefits of having healthy employees and financially healthy employees. There's a lot of research out there, and if anybody would like some resources, we can get you those. But it's very powerful for an employer. You know, there's less absenteeism, there's more mindfulness around the office. When people are less stressed in their financial life, they're going to be better employees. And you know, it seems to many of us to be common sense, but I think it's worth the investment for employers to look at what do we want to do to help our employees with organizations like HealthLinks to develop strategic alliances and have conversations about what it's going to take to change our financial mindsets and create healthy financial environments in the workplace.
Absolutely, and thank you for highlighting that. That is definitely true, and even our work with employers shows that the first thing that employees need help with, and the one of the main areas where they get their stress from, is their finances, and having simple workshops or lunch and learn opportunities for them, connecting them to the right people to help sort out their finances, can go a really long way into their overall health and happiness in the workplace. So it's definitely a huge topic to focus on, and it's not the first thing that comes to mind when we think of a health or safety program, but definitely incorporated in there. So I think that's why we brought Danielle in to present today and have her on our website to connect with. And there are a lot of other resources in the community to help with finances. So we always try to push those and move you in the right direction to help ease the stress and the burden that comes from not understanding, I think, mostly what we can do with our finances. Well, it doesn't look like any questions are coming through for you, Danielle. So thank you all again for taking the time to join us. If you have more questions that you think of later, feel free to reach out to Danielle. She's always great at responding quickly and helping you with whatever you need. Her contact information is on the screen, and then I'll share it again in a direct link through the email. I'll let you all get back to your days. Have a wonderful afternoon, everyone.
Thank you so much.
Thanks, Danielle. Bye.
Bye-bye.